Friends, thank you for being here today. What if I told you that the global economy isn't stabilizing? It's entering the final act of a tragedy that began 35 years ago in Tokyo. What if the invisible force that has kept your mortgage cheap, your retirement fund inflated, and your dollar strong has just vanished, not gradually, but in the span of 48 hours? On November 28th, 2025, the Japanese government approved something the financial media is calling a stimulus package. That's the sanitized term. The reality is far more visceral. Prime Minister Sanae Takaichi, a politician known not for restraint but for spending like a government fighting its final war, forced through an 18.3 trillion yen supplementary budget. To fund this, Japan must issue 11.7 trillion yen in new bonds. That's $75 billion of fresh debt that must be sold into a market that has no appetite left. Let me give you the scale of what we're discussing, because scale is where denial collapses into comprehension. Japan's debt to GDP ratio now stands at 232.7%. This is not a record for Japan. It is a record for any developed nation in modern history. To put it simply, for every dollar Japan produces in economic output, they owe $2.33. This is not sustainable. This is not manageable. This is mathematical inevitability staring us in the face. But here's where it gets interesting. And by interesting, I mean catastrophic. Japan is not just any debtor nation. Japan is the world's largest creditor nation. For 3 decades, Japanese institutions have been the silent whale in the ocean of global finance, quietly accumulating over $3 trillion in foreign assets, most of it in US Treasuries, European bonds, and American stocks. They did this because their own government kept domestic interest rates at zero for 30 years, forcing savers and banks to flee their own country in search of yield. Now, that flow is reversing. The 10-year Japanese government bond yield just broke 1.835%, a level not seen since 2008. The 20-year yield hit 2.855%, the highest since 1999. These numbers might sound boring to you, but to the Japanese banking system, they represent an existential threat. Because when rates rise, the value of old bonds collapses, and Japanese banks are holding trillions of yen in old bonds that are now hemorrhaging value in real time. This is what I call a structural fault line, not a policy mistake, not a temporary disruption. A fault line, a crack in the foundation of the global financial system that has been widening for decades and has now begun to split open. The mainstream narrative will tell you this is about Japan's domestic problems, but that is a lie of omission. When the largest creditor nation in the world starts selling assets to defend its currency and shore up its banks, the entire edifice of global debt starts to crumble. And here's the part that should terrify you. Japan has two choices to fund this $75 billion spending spree. They can print yen to buy their own bonds, which will send the yen into hyperinflation and destroy what's left of their credibility. Or they can sell US Treasuries, which will spike yields in America, crash the housing market, and trigger the unwinding of the largest carry trade in human history. They are choosing the latter. This is not speculation. This is already happening. Let me take you back to where this story truly begins, because you cannot understand the end game without understanding the genesis. In the 1990s, Japan made a decision that would echo across 3 decades and reshape global finance. After their asset bubble burst, real estate and stock prices cut in half, the Bank of Japan dropped interest rates to zero and kept them there. This was called the zero interest rate policy, or ZIRP. It was meant to be temporary. It became permanent. When you keep rates at zero for 30 years, you create a perverse incentive structure. Japanese savers, who are among the most diligent savers in the world, looked at their bank accounts offering 0% and said, "We need to go somewhere else." Japanese insurance companies, pension funds, and banks holding trillions in deposits looked at Japanese government bonds yielding nothing and said, "We need to go somewhere else." So they did. They poured $3 trillion into foreign assets, US Treasuries, European bonds, American stocks, emerging market debt, anything that offered a return. This created what traders call the carry trade, borrowing yen at 0% and investing it abroad at 3, 4, 5%. It was free money. It was the global ATM, and the entire world lined up to use it. Think of it like this. Imagine you could take out a mortgage at 0% interest, truly zero, and use that money to buy rental properties that generate 5% annual returns. You pocket the difference. No risk, pure arbitrage. Now imagine that mortgage lasts for 30 years. And imagine millions of investors doing this simultaneously with trillions of dollars. That was the carry trade. For 30 years, Japan was the lender of first resort to the entire world. Hedge funds borrowed yen to buy Bitcoin. Tech companies borrowed yen to buy back their own stock. Sovereign wealth funds borrowed yen to buy US real estate. It was the scaffolding beneath every asset price you see today: stocks, bonds, crypto, real estate, all of it inflated by Japanese liquidity flowing out of Tokyo and into every corner of the globe. But here's the twist that the textbooks don't teach you. This system only works as long as Japanese rates stay at zero. The moment rates in Japan start to rise, offering Japanese investors a decent return at home, the entire structure reverses. The money that left Japan starts coming back. This is what economists call repatriation. But that word is too clinical for what's actually happening. Repatriation shock. Trillions of dollars that have been parked in US and European assets for decades are now being liquidated and sent back to Tokyo, not because Japanese investors want to, because they have to. Let me introduce you to the canary in the coal mine, Norinchukin Bank. You've probably never heard of them. They're a century-old agricultural bank in Japan with a boring name and a terrifying balance sheet. Norinchukin is sitting on 17.3 trillion yen, that's over $100 billion, of foreign bonds. Most of it is US Treasuries and something called CLOs, or collateralized loan obligations, which are bundles of corporate debt. Earlier this year, Norinchukin announced they are liquidating 1.5 trillion yen of these holdings because they are forecasting a $9.5 billion loss for the fiscal year. Let me repeat that, a $9.5 billion loss. They are holding assets that are bleeding value because rates in Japan have risen and the value of their old low-yielding foreign bonds has collapsed. Norinchukin is not an outlier. They are the first domino. Every major Japanese financial institution, Mitsubishi UFJ, Mizuho, Sumitomo, is sitting on the same toxic portfolio, and they are all facing the same choice. Hold these bonds and bleed to death slowly, or sell them and take the loss now. They are choosing to sell. And when Japanese institutions sell $100 billion of US Treasuries, that is not a market event. That is a geopolitical event, because the United States relies on foreign buyers to fund its deficit, and the largest foreign buyer just walked away from the table. Now, why is this happening now? Why not 5 years ago? Why not 5 years from now? Because of a man named Kazuo Ueda. He is the governor of the Bank of Japan. And in 2023, he did something that Japanese central bankers have refused to do for 30 years. He let rates rise. He scrapped yield curve control, the policy where the Bank of Japan artificially suppressed long-term rates by buying unlimited bonds. The moment he did that, the Japanese bond market, the second largest bond market in the world, became a free market again. And free markets do not like 232% debt to GDP ratios. They do not like governments that need to issue $75 billion of new bonds when the market is already saturated. They do not like prime ministers who campaign on infinite spending with no plan to pay for it. So yields spiked. The 10-year Japanese government bond, which spent decades below 1%, blew through 1.8% in November of 2025. The market is screaming. And when bond markets scream, governments either listen or they collapse. This leads us to the system's most crucial secret, which we will explore in the next section. But before we go there, I need you to understand one thing. This is not a Japanese problem. This is a global architecture problem. Japan was the linchpin, the low-cost lender, the patient creditor, and the linchpin just snapped. Let's talk about the trigger event, the moment the markets realized this was not a drill. November 28th, 2025, Prime Minister Sanae Takaichi announces an 18.3 trillion yen supplementary budget. For context, Takaichi is a political animal known for one thing: spending. She ran on a platform of aggressive fiscal stimulus, promising to revive Japan's economy through government largesse. The financial press gave her a nickname. They call it the Takaichi Put, the belief that her government would step in and save any market downturn with unlimited spending. But here's what the press didn't tell you. Japan doesn't have the money. Their tax revenue for 2025 is projected at 70 trillion yen. Their interest expense on existing debt is already consuming a massive percentage of that. And now Takaichi wants to add another 11.7 trillion yen in new bond issuance. The market's reaction was immediate and brutal. Within 48 hours, the 20-year JGB yield spiked to 2.855%. Gold, a safe haven that thrives on sovereign debt panic, jumped to a 6-week high. Silver hit an all-time record high on December 1st, 2025, not because of industrial demand, not because of inflation expectations, because the market smelled blood in the water. And here's why the market panicked. Japan has two ways to fund this spending. Option one, print yen and have the Bank of Japan buy the bonds directly. This is called monetizing the debt, and it is the fast track to currency collapse. If the Bank of Japan prints 11.7 trillion yen, the yen, which is already trading near 156.82 against the dollar, will crash through 160, then 170, then who knows where. Imports become unaffordable. Inflation spirals. The government loses all credibility. Option two, sell foreign assets, specifically sell US Treasuries. Japan holds over $1 trillion in US Treasury bonds. If they liquidate even 10% of that to fund the stimulus and defend the yen, that is $100 billion of US debt hitting the market in a compressed time frame. And when supply overwhelms demand, yields spike. And when treasury yields spike, everything else collapses. Stocks, real estate, corporate bonds, everything. This is the trap, the no escape encirclement. Japan cannot print without destroying the yen. Japan cannot borrow without spiking their own yields and bankrupting their banks. And Japan cannot sell US Treasuries without crashing the American bond market and triggering a global contagion. So what are they doing? They are choosing option two, slowly at first, then all at once. Let me give you the forensic evidence. Norinchukin Bank, the canary we discussed earlier, is not alone. They are simply the most visible. In the past 6 months, Japanese institutional investors have been quietly liquidating low-yielding foreign bonds at a pace not seen in over a decade. The data is buried in footnotes and quarterly filings, but it is there. The flow has reversed, and it's not just the banks. The Japanese government itself has a war chest called foreign exchange reserves, over $1 trillion in US Treasuries that they hold to defend the yen during currency crises. In August of this year, when the yen briefly spiked to 140 due to the carry trade unwind, the Ministry of Finance intervened and sold dollars, which means they sold US Treasuries. They did it again in September. They will do it again in December. Every time Japan defends the yen, they sell our debt. And every time they sell our debt, they push US Treasury yields higher. And every time US yields rise, the cost of borrowing in America goes up. Mortgages, car loans, corporate debt, government debt. The entire American economy is built on cheap credit. And the spigot of cheap credit is closing because Japan needs the money back. Now, let me introduce you to the second canary, the widowmaker trade. For 20 years, hedge funds have tried to short Japanese government bonds, betting that Japan's debt spiral would eventually cause yields to spike and bond prices to collapse. For 20 years, they lost money. The Bank of Japan crushed them every time by buying unlimited bonds and capping yields at zero. Traders called it the widowmaker because it destroyed careers. But in November 2025, the widowmaker woke up. Yields exploded. The traders who held on, who refused to cover their shorts, are finally being vindicated. And the signal this sends to the market is devastating. If Japan can no longer control its own bond market, then the era of central bank omnipotence is over. Think about what that means. For 15 years since the 2008 financial crisis, the entire global economy has operated on one assumption. Central banks can print unlimited money to stabilize markets. Japan pioneered this. The Fed copied it. The ECB copied it. It was the new normal. But what happens when the pioneer abandons the strategy? What happens when the Bank of Japan says, we can no longer cap yields because we have run out of credibility? The answer is simple. Every other central bank loses credibility too. The entire scaffolding of post-2008 monetary policy collapses. And here's the most dangerous part. The contagion is mathematical. When Japanese banks sell $100 billion of US Treasuries, US yields rise. When US yields rise, the dollar strengthens. When the dollar strengthens, emerging market debt becomes more expensive to service. When emerging markets start defaulting, global credit markets freeze. When credit markets freeze, liquidity evaporates. And when liquidity evaporates, every asset class built on leverage collapses simultaneously. This is not a recession. This is not a market correction. This is the unwinding of the largest debt bubble in human history, and the fuse was just lit in Tokyo. The liquidity tide is going out, friends, and we are about to find out who has been swimming naked. Let me show you just how deep this rot goes, because the evidence is not hidden. It is simply ignored by those who profit from your ignorance. We need to talk about what happens when a currency starts to die, not collapse overnight, but slowly suffocate under the weight of impossible choices. The Japanese yen is trading at 156.82 to the dollar as of this week. That might not mean much to you, so let me translate it. The yen is weaker now than at almost any point in the past 30 years, except for a brief moment in 2024 when it touched 162. Here's why that number matters. The Japanese government has an invisible line in the sand at 160 yen to the dollar. When the yen crosses that threshold, the Ministry of Finance intervenes. They don't announce it with press releases. They don't hold conferences. They simply start selling US dollars, which means selling US Treasury bonds and buying yen to prop up the currency. They did this in July of 2024. They did it again in August. The cost estimates suggest they burned through $60 billion of their foreign exchange reserves in just 2 months. $60 billion of US Treasuries dumped into the market to defend a currency that is structurally weak because their government cannot stop spending. And now, with the yen at 156 and Takaichi preparing to flood the market with 11.7 trillion yen in new bonds, the pressure is building again. If, no, when the yen breaks through 160, the Ministry of Finance will have no choice but to intervene again. And every intervention means more US Treasuries sold, more upward pressure on American yields, more stress on the global financial system. This is what I call kinetic financial war. It is not fought with tanks or missiles. It is fought with bond sales. Japan is not trying to destroy the US bond market. They are simply trying to survive. But the effect is the same. When you are drowning, you do not care if you pull others under with you. Now let's talk about the domestic consequences inside Japan, because this is where the spiral becomes inescapable. Japanese banks hold trillions of yen in Japanese government bonds on their balance sheets. These bonds were purchased years ago when yields were zero or even negative. A 10-year JGB yielding 0.1% was considered normal. But now, with the 10-year yield at 1.835%, those old bonds are worth significantly less. This is not speculation. This is bond math. When yields rise, prices fall. And when you are a bank holding trillions in bonds that have lost 20, 30, even 40% of their value, you have a solvency problem. Norinchukin Bank is simply the first to admit it publicly. Their 1.5 trillion yen loss is not an anomaly. It is a warning shot. Every regional bank, every insurance company, every pension fund in Japan is staring at the same hole in their balance sheet. And they have two choices: realize the loss now by selling, or hold the bonds and pray that yields come back down. But yields are not coming back down. The Bank of Japan has already signaled they will not restart yield curve control. Governor Ueda has made it clear The era of artificial rate suppression is over. Japan is going to have a real bond market again with real price discovery. And real price discovery for a country with 232% debt to GDP is not pretty. So the banks are selling, not just foreign bonds, domestic bonds too. And when domestic institutions start selling Japanese government bonds, the government has a crisis. Because who is going to buy all the new debt that Takaichi wants to issue? For 30 years, the answer was simple: Japanese households, Japanese banks, and the Bank of Japan. Japanese households are the most diligent savers in the world, and they dutifully bought JGBS even when they yielded nothing because they believed in the safety and stability of their government. Japanese banks bought JGBS because they had no other domestic option, and when demand flagged, the Bank of Japan stepped in and bought unlimited quantities to keep yields pinned at zero. But that system is broken now. Japanese households are aging, the population is shrinking, savings rates are declining. Japanese banks are underwater on their existing bond holdings and cannot afford to buy more. And the Bank of Japan, after years of buying so many bonds that they now own over half of the entire JGB market, has reached the limit of credibility. They cannot buy more without destroying the currency. So who is going to buy 11.7 trillion yen in new bonds? The answer is no one, unless yields rise high enough to attract buyers. And if yields rise high enough to attract buyers, the interest expense on Japan's existing debt becomes unsustainable. This is fiscal dominance. It is the point where the central bank loses control because the government is spending too much. The central bank wants to fight inflation by raising rates, but the government cannot afford higher rates because the debt is too large. So the central bank is trapped. And when central banks are trapped, currencies collapse. Let me give you one more piece of forensic evidence, and this one should chill you to the bone. In the last 6 months, foreign investors, meaning non-Japanese investors, have been net sellers of Japanese government bonds for the first time in over a decade. These are the so-called bond vigilantes, the global macro hedge funds and sovereign wealth funds that move billions of dollars based on fundamental analysis. And their analysis is telling them one thing: get out of Japan. The bond vigilantes are not sentimental. They do not care about Japan's history or culture or resilience. They care about math. And the math says that a country with 232% debt to GDP, a shrinking population, and a government that just approved an 18.3 trillion yen spending spree is heading for a reckoning. When the bond vigilantes abandon you, the game is over, because once foreign capital flees, domestic capital follows, and once domestic capital flees, the only buyer left is the central bank. And when the central bank is the only buyer, you have hyperinflation. I want you to sit with that for a moment. Japan, the third largest economy in the world, the land of technological innovation, the birthplace of lean manufacturing, the country that rebuilt itself from the ashes of World War II, is now facing the same fiscal spiral that destroyed Argentina, Venezuela, and Zimbabwe. The difference is that Japan is not a peripheral economy. Japan is the linchpin. And when the linchpin breaks, the entire structure collapses. Now we arrive at the convergence, the point where all the separate threads we have been tracing, monetary policy, fiscal recklessness, currency stress, institutional failure, come together into a single inescapable reality. We are facing a trifecta, three distinct forces hitting simultaneously, each one amplifying the others. Force 1, fiscal recklessness. Prime Minister Takaichi's 18.3 trillion yen supplementary budget is not an emergency measure. It is a kamikaze mission. She knows Japan cannot afford this. Her advisors know Japan cannot afford this. But she is doing it anyway because the political cost of austerity is higher than the economic cost of collapse. At least that is what she believes. She is wrong. When the bond market revolts, there is no political survival. There is only capitulation. Force 2, institutional capitulation. Norinchukin Bank selling $63 to $100 billion of foreign bonds is just the beginning. Mitsubishi UFJ, Mizuho, Sumitomo, Japan Post Bank, every major financial institution in Japan is staring at the same losses. They will all sell. And when they sell, the pressure on US Treasury yields becomes exponential. We are not talking about a 10 or 20 basis point move. We are talking about a structural repricing of risk across the entire global bond market. Force 3, safe haven rotation. And here is where it gets truly interesting. As sovereign debt loses credibility, capital does not simply evaporate, it rotates into assets with no counterparty risk. Gold demand is up 10% year over year. Central banks around the world, China, Russia, Turkey, Poland, are buying gold at the fastest pace in over a decade. Analysts are projecting gold prices to rise 42% in 2025. Not because of inflation, not because of geopolitical risk, because of sovereign debt crisis. When central banks, the very institutions that issue fiat currency, start buying gold, they are telling you something. They are telling you they do not trust each other's currencies anymore. They are preparing for a reset. Now let's talk about psychology, because this is where most people lose money, not because they don't understand the mechanics of the crisis, but because they cannot overcome their own cognitive biases. The first bias is normalcy bias. Human beings are hardwired to believe that tomorrow will look like yesterday. We extrapolate from recent experience. Japan has been in a debt spiral for 30 years, and for 30 years they have muddled through. The Bank of Japan printed money, yields stayed low, the system held together, and so investors assume the system will hold together again. But that assumption is based on a false premise. The reason Japan muddled through for 30 years is because they had external support. Japanese banks could buy US Treasuries yielding 3% when domestic bonds yielded 0. Japanese households could rely on deflation to preserve the purchasing power of their savings, and the Bank of Japan could suppress yields without destroying the currency because everyone believed in their credibility. All three of those supports are gone. US Treasury yields are falling because the Fed is cutting rates. Deflation has turned to inflation in Japan. Core CPI is running above 2% for the first time in decades. And the Bank of Japan's credibility evaporated the moment they scrapped yield curve control and let the market set prices. The safety net is gone, and yet investors are still acting like it exists. They are still buying Japanese stocks, still holding Japanese bonds, still assuming that someone will step in and save the day. There is no someone. The cavalry is not coming. You are on your own. The second bias is the money illusion. This is the belief that if your net worth is going up in nominal terms, you are getting richer. But nominal wealth is an illusion when the currency is collapsing. You can become a millionaire on paper and still be poorer at the grocery store. Let me make this concrete. Imagine you own Japanese stocks, a diversified portfolio of Toyota, Sony, Mitsubishi. Over the past year, the Nikkei index has been relatively stable in yen terms. You look at your brokerage account, and the number hasn't changed much. You think you are safe. But in dollar terms, you have lost 20% of your wealth because the yen has collapsed against the dollar. And if you are a Japanese household, you have lost purchasing power on every imported good, energy, food, electronics, medicine. The number in your account is the same, but the value of that number has evaporated. This is the insidious nature of currency collapse. It does not announce itself with sirens and flashing lights. It creeps in through the price of gasoline, the cost of groceries, the utility bill you can barely afford. By the time people realize what is happening, it is too late to move their wealth to safety. And here is the cruel irony. The Japanese government knows this. They are engineering a slow motion default through currency debasement. They cannot pay back their debt in real terms, so they are paying it back in devalued yen. It is a default in all but name. And the people who suffer are the savers, the retirees, the middle class, the very people who lent the government money in good faith. This is not a conspiracy. This is stated policy. Modern monetary theory, the idea that governments can print unlimited money as long as they control inflation, has been tested in Japan for 30 years. And the test is failing. Inflation is rising. The yen is collapsing. And the government's response is to spend even more and hope the problem resolves itself. It will not resolve itself. The end game is mathematical. Now, let me address the question I know you are thinking. What about the United States? If Japan is in a debt spiral, what does that mean for America? The United States has $38 trillion in federal debt. The debt to GDP ratio is 123%. Not as bad as Japan, but still in dangerous territory. And just like Japan, the United States relies on foreign buyers to fund its deficit. For decades, those foreign buyers were Japan and China, but China has been reducing its holdings of US Treasuries since 2013. And now Japan, the largest foreign holder of US debt, is starting to sell. When your two biggest creditors walk away, you have two options: find new buyers or raise yields to attract buyers. The problem is there are no new buyers. Domestic demand for treasuries is saturated. The Fed is no longer running QE, and private investors are demanding higher yields to compensate for the risk. So yields rise, and when treasury yields rise, the cost of servicing the US debt rises. The United States currently spends over $1 trillion per year on interest payments, more than it spends on defense, and that is at relatively low rates. If the 10-year Treasury yield rises from 4% to 6%, the interest expense becomes $2 trillion per year. At that point, interest payments consume the entire federal budget. There is no money left for Social Security, Medicare, defense, or anything else. This is the sovereign debt spiral. It is the same spiral that consumed Japan, and it is coming to America faster than anyone wants to admit. But here is what separates those who survive from those who are wiped out: action. You are facing a binary choice right now. You can own assets or you can own claims on assets. Let me explain the difference, because this distinction will determine whether you preserve your wealth or lose it. A claim on an asset is a financial instrument, a stock certificate, a bond, a dollar bill, a number in a bank account. It is a promise that someone will give you something in the future. The key word is promise, and promises can be broken. When governments collapse, when currencies hyperinflate, when banks fail, those promises evaporate. The number in your account might say 1 million, but if the currency is worthless, you have nothing. An asset, on the other hand, is something real: gold, silver, land, a productive farm, a business with hard assets and real cash flow. These things do not depend on anyone's promise. They have intrinsic value. And when the monetary system resets, and it will reset, assets survive, claims do not. Gold and silver are hitting record highs right now for a reason. It is not because of industrial demand. It is not because of jewelry consumption. It is because the smart money, the central banks, the sovereign wealth funds, the billionaires who have access to information you do not, are rotating out of paper and into hard assets. They see what is coming, and they are positioning accordingly. Let me be very clear about what I am advocating here. I am not telling you to sell everything and buy gold because I think gold is going to the moon. I am telling you to own gold and silver because they are the only assets with no counterparty risk in a world where counterparty risk is exploding. When Japan sells US Treasuries, Treasury yields spike. When Treasury yields spike, bond prices collapse. When bond prices collapse, pension funds take losses. When pension funds take losses, they sell stocks to raise cash. When stocks fall, margin calls trigger. When margin calls trigger, leveraged investors are forced to liquidate everything: crypto, real estate, commodities, everything. This is contagion. This is the cascade. And the only way to step out of the blast radius is to own assets that are not part of the leveraged system. Gold and silver are not someone's liability. They are not dependent on a government's solvency or a central bank's credibility. They simply are. And in a world where nothing else can be trusted, that matters. History favors the prepared. Every monetary crisis in history, Weimar Germany, Zimbabwe, Argentina, Venezuela, has followed the same pattern. First, the government borrows too much, then the central bank prints to cover the deficit, then the currency collapses, and then those who held gold survive, those who held paper do not. We are in the opening act of that same play right now. The difference is that this time it is not a peripheral economy. It is Japan. And when Japan falls, it will take the global financial system with it. The window for preparation is closing, friends, not in years, not in months, in weeks. Japan's debt nuclear option is not a hypothetical scenario. It is happening right now. The bond issuance was approved on November 28th. The yields are spiking today. The currency is weakening in real time, and the selling of US Treasuries has already begun. You can choose to believe that someone will fix this. You can choose to believe that central banks still have tools left to deploy. You can choose to believe that the system will muddle through one more time. Or you can look at the math, look at the history, and understand that we are past the point of no return. I choose the latter, and I hope you do too. Thank you for being here today, friends. The next chapter of this story is going to be written in the bond markets of Tokyo and Washington. And when it is written, it will reshape the global economy in ways most people cannot yet imagine. Step out of the line of fire. Own assets, not claims. and prepare for the reset that is already underway. Before we close, I want to address the objection I know some of you are raising right now. You are thinking, Japan has been in crisis for 30 years. They have always found a way out. Why is this time different? It is a fair question, and the answer is brutally simple. Because the architecture of the global financial system has fundamentally changed. In the 1990s and 2000s, when Japan first entered its debt spiral, the world was awash in liquidity. China was growing at 10% per year, generating massive demand for Japanese exports. The United States was running moderate deficits and had credible fiscal discipline. Europe was stable. Emerging markets were booming. In that environment, Japan could afford to keep rates at zero and export its way out of trouble. That world no longer exists. China's economy is slowing. Real estate developers are defaulting, local governments are bankrupt, and youth unemployment is at record highs. The United States is running $2 trillion deficits with no plan to reduce them. Europe is facing an energy crisis and deindustrialization. Emerging markets are drowning in dollar-denominated debt. There is no external engine of growth to rescue Japan this time. They are on their own. And when you are on your own, with 232% debt to GDP and a government that just approved $75 billion in new spending, the math does not work. Let me give you one final piece of evidence that should crystallize the urgency of this moment. In the last 3 weeks alone, since Prime Minister Takaichi announced the supplementary budget on November 28th, we have seen the following cascade. The 20-year JGB yield hit 2.855%, the highest since 1999. Gold surged to a 6-week high as safe haven demand exploded. Silver hit an all-time record high on December 1st, driven entirely by sovereign debt fears. The yen weakened to 156.82, putting it within striking distance of the intervention threshold. Norinchukin Bank confirmed they are accelerating the liquidation of foreign bond holdings, with estimates now ranging up to $100 billion. This is all happening in real time. This is not a forecast. This is not a model. This is observable reality unfolding in front of your eyes. And yet, the mainstream financial media is barely covering it. Why? Because the implications are too terrifying to acknowledge. If Japan, the world's largest creditor, the most disciplined saver culture, the country that rebuilt itself from World War II, cannot escape the sovereign debt trap, then no one can. Not Europe, not the United States, no one. The contagion is not coming. The contagion is here. It is simply moving slowly enough that most people do not notice. But slow motion disasters are still disasters. And by the time the panic sets in, it will be too late to move. Let me paint you a picture of what the next 6 to 12 months could look like if this trajectory continues. Japan continues issuing bonds to fund Takaichi's stimulus. Yields continue rising because domestic demand is exhausted and foreign buyers are fleeing. To prevent a complete bond market collapse, the Bank of Japan is forced to restart yield curve control, buying unlimited bonds to cap yields. But this time, the market does not believe them. The yen crashes through 160, then 170, then 180. Imports become prohibitively expensive. Inflation accelerates to 5%, then 7%, then 10%. The Japanese middle class, who saved diligently their entire lives, watches their purchasing power evaporate. In desperation, the Ministry of Finance sells $200 billion of US Treasuries to defend the yen. US Treasury yields spike from 4% to 5.5%. The US housing market, which was already teetering due to high mortgage rates, collapses. Home prices fall 20 to 30% in major cities. The carnage spreads. Pension funds holding long duration bonds take catastrophic losses. Margin calls trigger across the derivatives market. Hedge funds that were betting on low volatility suddenly face redemptions and are forced to liquidate everything: stocks, commodities, crypto. The S&P 500 falls 30% in 3 months. Bitcoin, which many believed was a safe haven, crashes 50% because it was funded by leverage. The illusion of wealth vaporizes, and through it all, gold and silver rise, not because they are producing anything, not because they are generating yield, but because they are the only assets left standing when the paper system collapses. This is not fear mongering. This is pattern recognition. This is understanding that every fiat currency system in history has eventually collapsed under the weight of unsustainable debt. And this time is not different, it is just bigger. Now, I want to be very clear about something. I am not telling you this to scare you into action. Fear is not a strategy. Panic is not a plan. I'm telling you this because you deserve to understand the structural forces at work in the global economy. You deserve to know why the system is fragile, and you deserve the opportunity to prepare before the window closes. Some of you will take this information seriously. You will evaluate your portfolio. You will ask yourself, how much of my wealth is dependent on the solvency of governments and the stability of currencies? And if the answer is most of it, you will make changes. You will allocate to hard assets. You will reduce counterparty risk. You will step out of the blast radius. Others will dismiss this as doom and gloom. You will believe that the system is too big to fail, that central banks are too powerful, that they will never let a collapse happen, and you will continue holding paper assets, confident that someone will save you when the crisis comes. I cannot tell you which path to choose. I can only tell you what the data says. And the data says that Japan's debt nuclear option is not theoretical, it is operational. The selling of US Treasuries has already begun. The yields are already rising. The contagion is already spreading. The question is not if the system will reset. The question is when, and whether you will be positioned on the right side of that reset. Let me leave you with one final thought. In every great financial crisis, the Great Depression, the collapse of Bretton Woods, the 2008 financial crisis, the COVID crash, there were people who saw it coming. They were not prophets. They were not geniuses. They simply paid attention to the fundamentals and understood that when debt becomes unsustainable, something has to give. Those people positioned themselves accordingly. They owned assets instead of claims. They prioritized preservation over speculation. And when the crisis came, they not only survived, they thrived. Because in every reset, wealth is not destroyed, it is transferred from those who believed the illusion to those who understood the reality. Right now, you have a choice. You can be on the receiving end of that transfer, or you can be on the losing end. The information is in front of you. The tools are available. The window is still open, but it is closing fast. Japan has pulled the trigger on the nuclear option. The repatriation shock is underway. The global bond market is beginning to crack, and the safe haven rotation into gold and silver is accelerating. The only question that matters now is, what are you going to do about it? I hope you will choose wisely. I hope you will act with urgency. And I hope that when we look back on this moment a year from now, you will be among those who prepared, not those who hoped. Thank you for being here today, friends. This has been a difficult conversation, but a necessary one. The road ahead is uncertain, but those who understand the terrain will navigate it far better than those who do not. Stay vigilant, stay informed, and most importantly, stay prepared. The architecture of the global financial system is crumbling. The linchpin has snapped, and the edifice that took 70 years to build is beginning to implode. History favors the prepared, and the window for preparation is closing. I will see you in the next one.